All right, everybody. Well, thank you so much for. Oh, you know what? I'm sorry. Technical difficulties, technical difficulties. I pulled up the wrong PowerPoint. I was using a slide from that one for the one that we're gonna do. Um, Hold on. Sorry, they pay me to be a financial planner, not the marketing person. All right. All right, take two. Cut. Uh, well, thank you so much, everybody, for getting here today. We're gonna be talking about estate planning because that's what you all signed up for. If you do have questions on college planning, we covered that last month, and there is a recording. So please let me know if you want a copy of that one. But we're gonna get started here. So. My name is Lucas Amel. For those of you that don't know me, I'm really excited to be kind of talking about this topic today. It's one that I hold near and dear to my heart, and I think most people have been through estate planning one way or the other, whether it was a proactive or a reactive situation. I've got a lot of stories to share today, but we know that, the route of financial well-being is going to look a little different for everyone, regardless of what path you're on, what path you take. Having a strong grasp of the overall fundamentals is absolutely imperative, right? So today's discussion is designed to empower you to begin thinking about the different estate planning topics and tools that are out there for you if you haven't done so already, or maybe you have done some research or started interacting with attorneys and just want to kind of broaden your understanding of, what's out there, what are you supposed to be utilizing, what are the different tools that are available to you. Maybe you already have a formal estate plan and you're just looking at potentially revising it or just making sure that you're okay, right? And I think that's something that people should be looking into every couple of years is life changes, right? Your assets are going to change, what you own, what you care about, what you value, and ultimately too, your family structure is going to change over time, right? Births happen, divorces happen, deaths happen. Like this stuff changes. Your estate plan, it's not something that you set up once and you never look at again. It's something that you do want to constantly revisit, similar to your overall financial plan, just to make sure that it's still in alignment with what you're trying to do. Right. So, I don't like talking about myself, but at the same time, too, I do feel that it's prudent every once in a while. I am here as a subject matter expert. So I'll give you my quick little, a commercial on myself, right? My name is Lucas Amel. I've been a financial planner, a fiduciary financial planner for a decade now. I started right out of college. That's why I am younger, but trust me, my level of exposure has been at a very high level, right? I came from a background of studying finance. I've passed all the fancy tests, the Series 7, the Series 66, becoming a fiduciary, becoming a financial planner, getting licensed with all these things. And putting letters behind my name, which I should add to the slide. I passed some more tests, but ultimately what I like to share with people is I've been doing this for a decade at a very, very high level, right? I've been servicing probably over 1,000 families over that time. I used to do taxes. I'm managing upwards of $100 million at this point with my team. And just what I'm trying to communicate with that is, I've seen pretty much everything under the sun that can happen for people, right? Good and bad. And the reason why we do these presentations, the reason why Advocate allows us to do these is because everybody knows somebody that stuff didn't really go that well for. And the biggest reason why things don't go well for people in the financial world is because they're not prepared. Okay. Proactivity is the biggest ingredient to financial success. And we want to today give all of you as many tools and as many tidbits of information as humanly possible so that you can be proactive with your situation, right? And I implore each and every one of you, work with professionals. I might be biased because I am in this space, right? But, if you need heart surgery, you don't do it yourself. You go to a heart surgeon. If you really need to lose weight and get in shape, it's harder to do it to yourself. go work with a personal trainer. Same with your financial situation. You should have an accredited tax person. You should work with a licensed attorney to get your estate planning documents in order. And you should work with a competent fiduciary financial planner that can help quarterback the whole situation. Okay, so that's ultimately what I wanted to share on this slide. Enough about me. If you have more questions, I'm all over the internet, right? Who I'm not, right? I'm not an attorney. I am not a tax person, kind of, and I am not giving anybody on this call specific advice. This is meant to be general. This is meant to be broad. We're just trying to put information in your hands so that, like I said, you can be proactive with your situation. And that proactivity at the end of the day is just going to give you more peace of mind. Okay, so before we kind of dive into the meat and potatoes here, I want to make sure that people understand what we mean by financial well-being. Okay, so this has been an ongoing series that we've been kind of touching on. We do these every month. We've honestly been doing them every month now for, I think, 3.5 years. That sounds about right. We started maybe in March of, yeah, about 3.5 years. And that topics that we're covering are timely and top of mind for people. So when we're thinking of financial well-being, there is a definition that's been offered by like the Consumer Financial Protection Bureau, right? And they look at these four cornerstones and they deem this as what's most important to people from a financial standpoint. Okay. The first cornerstone of financial well-being is having control over your day-to-day or your month-to-month finances, right? This means ultimately having a budget, keeping a budget, and understanding what that cash flow looks like, right? It's astounding to me how many families, how many households that I interact with on a regular basis. That's one of the first questions that I ask people ultimately is like, well, how much money is coming in? How much money is going out? Where's it going? Where's it coming from? A lot of people don't have a genuine conceptual understanding of the flow of their cash, right? And for you to be a prudent financial person, you need to have an understanding of where your money's going, right? So having a budget, if you take the time over the next month, over the next 3 months to track all of your spending and knowing where it's going and having some kind of budget established for yourself, you're going to be miles ahead of a lot of people. It's only 55% of people actually do have a solidified budget. Okay. Next, having the capacity to absorb financial shock. This ultimately just means having an emergency fund, having some kind of different liquid assets, having different buckets that you can pull from at different times without needing to worry about getting penalized significantly, without needing to worry about like taxes and getting screwed over and getting pushed into a higher bracket. You need some kind of order of operations for when you need money, right? So a rule of thumb is for an emergency fund, you should have maybe 500 to 1500, depending on your lifestyle, of money just totally set aside, total rainy day, car breaks down, roof starts leaking, furnace poops out, like whatever that looks like, you need some kind of a cushion, right? Beyond that, a general rule of thumb in the financial world is to have 3 to almost 6 months of salary set aside in like a high yield savings account that's giving you more than what a traditional bank would be for those very unforeseen circumstances, right? But guess what? I see it all the time. Illnesses happen, right? People get diagnosed with cancer and they need to go through chemo and they can't work. And guess what? Like long-term disability, short-term disability, it does not pay what you're used to. Typically, it's going to pay out about 50% of your salary, and that amount is taxable, right? So you want some kind of cushion to be able to fall back on in the case of layoffs, right? Company restructuring, reduced hours, illness. It's important that you have some kind of a fallback that can help you absorb financial shock, okay? Because financial shock will happen. You never know how, but it does happen to people and it's very, very common. Okay. Thirdly, here, being on track to meet financial goals, right? I think the first step of being on track to meet them is having them. Okay. We do an entire presentation on goal setting. It's on our YouTube channel. I can have my staff people send it to you directly if you send us an email. Having financial goals is important, and it's important that they're specific, right? They always say if you're setting goals, make them a SMART goal. And you're all medical people. You love acronyms, right? So specific, measurable, actionable, realistic, and time bound, SMART. So it's important to have those goals defined. And you're just going to feel a lot better if you have defined goals and you've broken down how to accomplish them on a month to month or a day to day basis. And you know you're doing those things. I think as a financial planner at a high level now, one of the biggest things that I've noticed and realized my role is in a lot of people's lives, because let's be real, people don't talk to me because they don't have money, right? They have money, they have a lot of money usually, and they need to know what to do with it. And ultimately, they need permission to spend it, right? And having those goals, having a budget, having a path and a track that you know you're running on and within probability it's going to get you to where you want to be, it makes spending your money a whole lot easier to enjoy life, right? Like you're not supposed to just die on a big pot of money, okay? Or just leave your kids all your money. You're supposed to live richly as well. And that's what we're here for, is to help you live richly, but not be worried that you're going to run out or get screwed over by taxes or fees or just the uncertainty of life. I get that. And this whole thing, it's not only is there financial components to it, but the bigger part of your finances is your relationship to them, right? There's a whole psychological roller coaster that comes along with your money. And it's important that you have a good team around you that can make you feel better about those things. Okay. Lastly, here, having the freedom that's going to allow you to make choices that you want to make. I kind of just hit on that, right? If you have an estate plan in place, if you have a budget in place, if you have a financial plan or a college plan in place, you can spend your money, you can enjoy your life. This is not supposed to be an over consuming, stressful thing that's out there for you. If anything, it should be inspiring once you have a plan in place and you know that you're working towards, a better future for you and your family. Okay. So let's kind of jump in here. What's our agenda, right? We're going to be talking about estate planning today. So it's going to be high level, but I'm going to try to hit on as many stuff as possible. Okay. So we're going to be a bit more focused on just setting up future financial well-being for your beneficiaries. Ultimately, that's what an estate plan is. I think that's why they're often overlooked, because in reality, you're not benefiting from your estate plan at all. You're really not. It's all about how you can die in the most financially responsible way, in a way that's going to be controlled, and in a way that your wishes carried on beyond the grave. Okay, so it's not that it won't have some positive impact during your lifetime, because there are some things from a tax standpoint, generally they don't apply to most people, but estate planning really is most important for helping define where your assets are going to go after you pass away, and ensuring that that's in place so your wishes are followed, right? So having everything in order and in a well-defined, well-thought-out estate plan, it's going to bring greater peace of mind to you, but ultimately for your loved ones as well. Okay, so first off here, we're just going to talk basics. What is an estate plan? What's included in an estate plan? What do you need? Who do you need to talk to get one started or set up? Right. Next, we're going to go over some of the different tools that are used in creating an estate plan. So wills, trusts, beneficiaries, life insurance, whatever it looks like. Every person's estate plan is going to be a little bit, not even a little bit. Every person's estate plan is going to be unique based on what they're trying to do, what they want it to look like. These are very customizable to your personal situation and family structure, right? So, for example, we do a lot of work with families with special needs, right? Their estate plan looks drastically different than, a married couple with one child without special needs. If a child with special needs inherits a bunch of money, they're very likely going to lose government benefits for their lifetime, right? So there's different kind of planning that goes into that. Same with children, I've seen this a lot, like with like addiction issues, gambling issues. If the parent passed away and left that kid $100,000, they're gonna blow it on drugs and OD, right? So they need certain kind of trusts established where that doesn't happen. Like these things get very complex. So that's kind of what I was saying. Like if you have specific questions about your circumstances, let's definitely set up a meeting and talk about it. But generally, we'll be able to cover kind of what the tools look like and stuff like that. Okay. Next, we're going to just go over some of the different strategies. I'll have stories to tell you. I'll make sure that we don't go over an hour because candidly, estate planning is one of my big passions within this industry. It's kind of how I got brought into the industry. I've been doing it since I started in an estate planning centric way because I just thought it was so important. And I kept finding how many people didn't do it. Right. And I could keep talking to people and keep talking to people, and they never had it figured out. So it was a way that I could add value to everybody I met. Right. So we're going to go over some strategies that you can kind of use as a general guideline, or at least to give you some ideas. Right. And then finally, we're just going to talk about some alternate like considerations just to keep in mind when you're kind of putting together your own plan. Okay. So let's, without further ado, kind of jump into it here. Right. So what is an estate plan, right? An estate plan, it's your strategy for transferring the assets upon your death. Okay. Estate planning is a process of developing a very specific plan that you want enacted in order to ensure that your wishes are being followed after you're no longer here to kind of call the shots with your money, with your estate. Okay. So your estate, just being basic here, is made up of all of your assets and debts that are owned by you. Okay, so this can include real estate. This includes bank accounts. This includes stocks, life insurance, personal property, jewelry, cars, kind of everything that you're ever tied to, everything that's in your name, right? You do not need to own anything expensive. A lot of people think this in order to own an estate. Everything you own is your estate, right? It's not just tied to rich people that live on lakes or whatever. Everybody has an estate no matter where you are. If you own something, you have an estate, right? I think one thing worth mentioning too is pets, right? That's often included in an estate plan, especially people that have like pets that live long. Like I meet people all the time that they were in their 60s and they bought like an exotic bird that's supposed to live 65 years, right? A parrot. It's a weird thing, but I see that in estate plans a lot, is like having a plan for what happens to your bird when you die, right? It's stuff like that, right? Like there's obviously a lot in your name. So you have an estate, some degree of an estate plan should be created for every single person. Okay. Whether it's as simple as a will, whether it's as complicated as a multi-purpose trust, like it goes all over the board. Okay. So even though you might not think of yourself as wealthy or like needing an estate plan, it really is going to make sense for you to create one, as we'll go through. And we'll talk about kind of why that's so important on our next slide here. Right. So why is having an estate plan so important? Okay. An estate plan, it's giving you control over what's going to happen to your assets at and after your death. Okay. Without one, it's completely out of your hands, right? It really is. And often it's sometimes out of your loved one's hands as well. It's going to fall into the courts. It's really probably the last place that you're going to want to go and look at that. Okay, so first and foremost, right, an estate plan, it establishes beneficiaries, right? And this is so important because without identified beneficiaries, your assets need to go through probate, right? It's a terrible process. It takes long, it's public, and you're actually paying for it. So if that happens, if your assets pass on without named beneficiaries, everything is dictated by state law on who is going to receive your assets after your death. Okay. And those recipients, they may not be who you wanted them to be. They may not flow in a way that you wanted them to flow. So that's why it's important that you go ahead and have something established prior to. Okay. So, like in estate plan, it's going to ensure a smooth transfer of your assets. Okay. So if you were to die without some kind of plan for your estate, without a will, which is called dying intestate or intestate, right? Your state's probate court, it's going to take a really long time to make a determination on who is getting your assets, because guess what? There's a long, long, long line of people in front of you that didn't have an estate plan, that now you just need to get in that queue, and you need to hire lawyers that you didn't want to hire, and stuff's going to happen with your assets that it maybe really wasn't your wishes. And once again, it is public that way too. You can literally go on a state website and look up probate court proceedings and see whose money went through them and where it went. It's actually a little creepy. So from a privacy standpoint, from a cost standpoint, to just a standpoint of like your wishes, sorry, I was just reading a question. There's a lot to it, right? So I'll answer more questions as we go to, because some of them might get picked up. So I'll try to plug in at the end if that's okay. So yeah, and then obviously there's a tax component. I don't think the taxes matter to as many people, that the thresholds got raised so significantly, but it's still kind of worth mentioning, like a well-constructed estate plan, it will also, or may also, help minimize estate taxes. There's different trusts that are out there that can kind of help reduce the size of your taxable estate and still allow you to maintain access, like your home and stuff like that. Another way of like reducing taxes through estate planning is just to take advantage of like gifting, right? That's a big thing that people do, is instead of just dumping a big lifetime inheritance on like your kids throughout the course of your lifetime and their lifetime, you kind of like bequeath them a small gift of, and I don't know what you call small, but like you can kind of gift like 10 grand a year and stuff like that. And it's oftentimes a better way to transition assets over to your heirs than giving them a fat lump sum of all taxable money that they're at some point going to need to pay taxes on at their high peak earning years, right? So there's a lot that you can kind of do. The overall estate tax, it really doesn't apply to most people. Like I think that it's like double millions right now. I think it's like 18 million if your estate's over that. That's when estate taxes start coming in. Most of the people I'm talking to really aren't at that level, at least not why I'm doing these presentations. It's a whole different part of my business. But yeah, so lastly, like I was saying here, and I think I've already hit on it, right? Like having an estate plan, it's important because it's limiting or avoiding probate. Okay, we touched on this briefly a moment ago, but probate, it's a legal process that's going to deal with your estate after death, right? In probate court, a judge is mandated to your case that you are paying for from your estate, and they're going to decide how your debt's getting paid, where your assets are going, how they're distributing, and it can take months to years depending on what court your debt like assigns to, and how many other people that did not have an estate plan are assigned to that same court. It is like my goal in life to make sure that nobody has to go through probate, because it is such an annoying process, and your heirs, or like the executor of your estate, they're already, like they're already grieving your death. They don't want to have to deal with all this crap and going to courts and doing this stuff and filling out more forms. Like if you can have everything established up front, so when you pass away, there's a smooth transition. And I will be candid with you, a smooth transition still takes a lot of time. They still need to fill out a bunch of forms. They still need to make sure that they're hunting down everything you have. It is very hard to have everything pre-packaged in a way that it makes you passing away and transitioning everything easy. I'm just going to be real. But that's why we do this. And that's why we're trying to encourage you guys to really be a lot proactive when it comes to estate planning. Hold on, I need a hit of my grapefruit juice here. I'm talking a lot. All right. So let's talk about some of the tools, right, that you can use during estate planning. I've got them listed here. I'm sure it's nothing really that you haven't heard of, but let's start with an overview. We can kind of dive into these a little more. The simplest form of an estate plan and the most fundamental tool that everyone, all caps, should have is a will. Okay. Like we mentioned earlier, trusts, they can be a helpful tool in estate planning because they can reduce the size of your estate. You can play with different ownership things. You can qualify for, subsidies for nursing homes. Like there's a lot of ways you can kind of play with a trust. They're very complicated. A trust almost deserves its own presentation, but they can be helpful for planning too. And then also too, gifting, right? Like you might not think of giving away money or assets during your lifetime as an estate planning strategy. However, it can be an extremely tax efficient way to transition portions of your estate while you're still alive. And then the same with life insurance, right? Life insurance, the death benefits of life insurance or the proceeds of life insurance are going to come to your beneficiaries tax free. So, it's a really good way to leave behind a legacy. What I'll see is a couple different strategies with life insurance, and I might cover this later, so I don't want to go too in depth with it, right? But, like one side of the coin, people will own life insurance policies because they know it's going to dump that tax-free benefit. So, what they'll do is sometimes pour pre-tax money like from a 401k or an IRA in and pay the premiums for a life insurance policy because they don't want their beneficiary inheriting this big tax bomb, right? This big tax burden that, as I said, they're going to need to start paying on at their income rate when they inherit it. So what a lot of people will do is be like, hey, I need to pay RMDs when I'm 72, 73 and a half, which means that the IRS is going to force you to start spending down that account anyway. If they don't need that money, what we'll do is put that into life insurance premiums. So it's reducing what their taxable estate is while building up a big tax-free death benefit. The other kind of strategy with life insurance with the planning side of things is that they'll take out the policy because they know that their beneficiaries are going to inherit that big tax burden, but then they'll get the life insurance proceeds to help cover the taxes, right? So these four things are cornerstone. At a minimum, no matter what your situation is, you should work to establish a will. Okay. It's just, I think it is in the slide. So I don't, there we go. Look at me go. So, just as I mentioned before, and it's very worth saying here, okay, everyone should at a minimum have a will. Okay, whether you're young, whether you're not so young, whether you're married, whether you're single, whether you have kids or you don't, you should have a will. There's a gazillion ways to get them set up. You can do it online for very inexpensive, and technology's become so prudent nowadays that it really can walk you through it quite well. I've done some of those just to try them out, like online will sites. You can usually get one for maybe like $100 too, sometimes less, maybe like 75 to $100. But it's not mega expensive to do one and get one drafted with an attorney. I'd really encourage you, especially if you maybe are on the older side, have a little bit more complicated of an estate or some more significant ownerships. Just bite the bullet, work with an attorney, two, three, $400 to get one set up and like feel really good about it. Okay. So let's go into like what is a will, right? Like generally, you're gonna kind of include four different categories of information in a will. Okay. So the first, it's a designation of beneficiaries, right? Who will receive your assets upon your death? Now, you can have more than one beneficiary, that's not a big deal. And you can designate certain assets to certain beneficiaries. So, like, you can choose people like your family, but also, too, you can choose friends, you can choose coworkers, like whatever it is. Or entities, right? This is where you can spell out charitable inclinations, stuff like that. So there's a lot of different ways that you can divide up the beneficiaries as you see fit. But going through the will is truly, it's just an exercise too to make sure that it's set up. Now, one thing that I want to note, and I'll probably remind you of this again a couple times throughout the PowerPoint, right? Is that a will in and of itself is not going to circumvent probate. Okay, you still need named beneficiaries on your investment accounts. That's one of the biggest things because, like, really, at the end of the day, a will is instructions to a probate court. Okay, if you don't have a beneficiary on your 401k, for example, but in your will, it says, I want my 401k to go to my cousin, right? The 401k when you pass is not automatically going to go there. It's going to go to probate. They'll review your will and then say it goes to your cousin. So it's extremely, extremely important that you have beneficiaries immediately titled on any kind of financial asset because those are the things that you do not want to go through probate ever. Okay. Because they're going to say, well, we're going to take 5% of it as a cost for like the probate fees. And you just do not want to do that. Okay. So outside of the beneficiary naming on the will, right, the next thing that it's going to include is a designation of an executor. Okay. And this is going to be the person that's carrying out your wishes that like after you passed. So in some states, they're going to call them a personal representative, and you can pick anybody for this, right? You can choose a friend, you can choose a spouse, you can choose a family member. Just make sure bulletproof that it's somebody that you trust, right? Like we've all heard stories of things where people try to embezzle money and like it's all that, right? So just make sure that it's somebody you can trust. You can kind of hire third parties for this, and I see some people do that, like where it's like a bank and stuff like that. Just to be clear, it has to be a disinterested person. Okay. So like if you're already working with a financial advisor, you can't be like, hey, Ed Jones guy, right? Like, can you be the executor of my estate? They cannot, right? It needs to be a disinterested person. Okay. So it's good to know that, right? Like just you want to figure that out. Oftentimes, probably 9 out of 10, it's like a very close family member or friend to serve as the executor. Sometimes we see, lawyers or banks doing it, but those are going to come at a cost. And, it's not always somebody that you really know. And people get a lot of comfort doing it with somebody they know. So, it might be advisable to hire an executor if you do not want any kind of conflicts of interest, nobody knowing what you had, that kind of stuff. But usually people are doing it with a family or a friend. You want to kind of consider whether the person you're thinking of designating is up for the task too. So typically, you want to talk to them, right? And be like, hey, like I'm putting together my estate plan when, because it's not an if, when something happens to me, would you be willing to do that? And really make sure that you clear that for them. I usually recommend that you have a backup, right? So like, for example, maybe you put it as your brother, right? And if your brother is unwilling or unable to deal with it at that time, you can have a backup where it's your best friend or whatever. Like I even see people put their parents and be like, well, if I predecease them, I would want my mom to take care of all this for me. You can absolutely do that. And you can have absolutely more than one executor named, and that's completely fine. Okay. So filing the will and an inventory of the state. Like, here's some of the responsibilities, right? So, like, they'll file your will with a probate court. They'll take an inventory of all your assets. They'll be working with the probate court to distribute what you have, right? Because it's somewhat to a degree unavoidable to have like a probate court involved in some capacity in the dispersion of an estate. So an executor will deal with them to be like, hey, the car needs to go here, the house needs to go here. She said in her will that this jewelry collection goes here, et cetera, right? The executor will have to notify all of your banks and all of your credit card companies and all of the people that love sending you bills and taking your money that, hey, they're dead. Stop sending us bills. They're not using these services. Like sometimes they have to cancel the services, go through a lot of stuff. It's not an easy process. I'll tell you that. There is a lot of paperwork that the executor needs to do. There's a lot of hoops that they need to jump through on your behalf, right? You need to set up oftentimes a separate bank account for any kind of incoming funds, right? So, like maybe there's still a social security payment that's going to come in, a pension payment that you're still entitled to, an annuity distribution, an RMD that was being processed. They need to often set up a separate bank account to take those inflows, take those outflows, et cetera, et cetera. But also too, they usually need to file a end of life tax return and stuff like that. So there's a lot and there's a whole checklist that these people need to go through, but it's not like nobody's ever done it before. It's not like there's not a lot of resources to help them make sure that they're able to wrap up your estate properly. Okay. Also too, when it comes to property, right? There's a lot of property that it's, hey, like, okay, what's happening with the house? Do we have to sell the home? Do we need to move that somewhere else? Like there's a lot of different things that need to be established and figured out as the person's going through things, right? Also, too, they're your representative in a state court, in probate court. That's why you really want to pick somebody that kind of knows you, knows your wishes. They can be an advocate for you, but at the end of the day, you're subject to the law is a big part of it, right? So it's a lot of work to be an executor. I've had to be an executor for like grandparents and stuff like that, and there's a lot that goes into it, right? Okay, and it is a personal decision as to whether or not you want to designate a friend, a family member, hire a professional. If you do decide to designate a family member or a friend, ask them that they are willing to do this because maybe they've done this for their parents and it caused them to lose hair, right? And that is true for some people. This is not a task for every single person, especially if they're not financially savvy or like as responsible. So kind of furthering on that, like with wills, a will is going to lay out when and how your beneficiaries will receive assets. Okay, so for example, like you can leave kids and grandkids money and just say, like, hey, I want this held in a trust or something like that until they're 18 or until they get married or until they buy their first home. I don't think a will gives you as much protection as doing that under a trust because it's not going to be fully administered by like a trustee, but you can spell those things out in a will. And if your guardian is on board and they really work towards your wishes, you can kind of spell that out a little more, right? And also, too, largely important, if you have children under the age of 18, a will is going to be where you're appointing guardianship in the event of you passing while they're still a minor. So if you do not make those appointments in a will, the court will designate guardianship. Okay. And usually you don't want that to happen, right? You really don't want the courts determining what's happening with your money, what's happening with your family. Like, have a will. It's everybody should have a will. Okay. So keep in mind, like the court can step in if your guardian declines to serve or is found not qualified to serve. So your choice of like similar to your choice of an executor, like make sure that the guardian is somebody that is willing, that is able, and that is somebody that you really, really trust. Okay. Speaking of trusts, let's jump over there. Right. And so I feel like usually this is where the most questions come up. Everybody's heard stories, whether good or bad, about trusts. I know I have a question in there, so I might take a peek at that too, because I know it's trust specific from what I'm hearing. But trusts, they can be a very important part of the estate planning process. They're not for everybody. So let's just take a moment here to consider, like what a trust is, right? So the word trust, may make you think of like the super wealthy. Okay. I think that most people think of that like a trust fund baby or something. They really don't know what a trust is, though. Okay. In reality, there are so many people that can benefit from having trusts. I'm not an attorney. I'm not trying to sell you a trust whatsoever. I just want you to understand where they can be implemented. Okay. So at the end of the day, a trust, it's a container that you put things into, and that container has fancy wording wrapped around it that dictate how and when and what that asset does and can be for you and the future generations. Okay. So these assets that you can put in a trust, you can think of it like a picnic basket, right? Like you can put in real estate, you can put in life insurance policies, you can put in investments, your car, your jewelry, everything can become property of that container. Okay. Sometimes, and this is where some people really goof up with trusts, is you can put that into a trust and you no longer own it. Okay. A trust is its own entity depending on how you set it up. And there's benefits, there's pros and cons to doing both of those things, right? If you set up a trust and it's an irrevocable, meaning that you don't own those assets anymore, you don't own those assets. So the con is you have no access to them without significant costs and penalties. Okay. But the pro is that you don't own them anymore. Okay. So a lot of people will do that like for nursing home planning where they say like, hey, Adam, like if I get stuck with dementia and I need to go into memory care and it's going to cost me $15,000 a month, which is not a made up number. Okay. I at a minimum still want to leave each of my kids 100 grand or 200 grand. Let me carve that out, put it in an irrevocable trust and bury it in my backyard. You can absolutely do that, and that nursing home cannot come after you. Even once you completely run out of money, you'll qualify for a government assistance program called like Title 19 or Medicaid, and they'll keep paying you as if you're totally broke, even if you got $1 million buried in your backyard. The issue is you can't touch that money. And that's where people always mess up trust planning is they're putting assets in things and giving up control over them without understanding what they're doing. And unfortunately, some of it comes because of attorneys overselling things and trying to make a dime. It is what it is. You need to work with competent people that you can trust to be on your team when you're doing estate planning. That's all I can say. Right. So going back to it, like I've got some other points I want to make sure I hit on while we're still here. Like some trusts are revocable. Okay. Meaning that you can change the terms, you can withdraw the assets, you have full ownership, you have full control over whatever you place in that container. Okay. This can be an extremely useful estate planning tool because the assets in the trust at your death do not, no matter what, go through probate. Okay. Part of having a trust is a very specific legal explanation as to where those assets go after you pass away. Bulletproof. Okay. It will not go through probate. That's the biggest benefit of a trust. Right. Instead, like the person that is the trustee, they can immediately implement your instructions that you leave in the trust language. Okay. So for tax purposes, you're still considered to own those assets that are in the revocable trust. It is titled to your name. It'll be in the trust's name, but they are tied to you. Okay. So going back to my nursing home example, because I see this a lot, right? Is if all of your assets are in a revocable trust and you're spending down, right? You're in that memory care facility costing you 15 grand a month. They can come after that money. It is in your name. Those are your assets. You can use them still during your lifetime for whatever because it is revocable. Okay. On the flip side, as I was saying before, there's another type, right? There's the two big types, revocable and irrevocable. Irrevocable means unchangeable, set in stone. Okay. This is a type of trust that you cannot really easily make any kind of changes after implementation. Okay. However, because you're giving up ownerships into that trust, generally speaking, that those assets, they're not included in your estate. Okay. So since they're excluded from your estate, They're not subject to estate taxes, so they can minimize that if you have a substantial estate. Structured properly too, this type of trust can provide protection from creditors. Okay, so any assets that are put into these, they're totally removed from you. It's like a separate thing. Okay, so now since they belong to that trust irrevocably, right? Meaning that you do not have access to those funds anymore, creditors cannot come after that too. So people with significant debts that still have a significant asset base, guess what? When you pass away, if you, and when your assets have to go through probate, which part of the reason why probate takes so long and is a public process is because that is making creditors aware that you passed away. Hey, all this person's money is up for grabs. Okay, so I've seen that a couple reasons. I'll throw some pepper in some stories here, right? And I'm gonna try to not talk too much, but like I know this is gonna be a longer presentation. So if you can't stay for the whole thing, just watch the recording. I don't know. People like this info though. This is one of my most popular presentations. There's 100 people on this call right now. So, like one of the things that I see a lot, say from a beneficiary, I'll start with the person, right? So say you have $100,000 in credit card debt and stuff like that. Guess what? If you pass away and your assets are going through probate, those credit card companies are immediately, because they have algorithms, they have full-time staff people that are like scouring probate records to see if there's anybody that owes them money. And they immediately come after that like sharks to blood, right? So that's one way that people will remove their estate to be like, hey, you know what? It sounds bad, but I want the credit card company to just default on my money. I want that money to go to my kids. That is a strategy. You can argue about the ethics of it. Okay. The other strategy when it comes to trust planning too is sometimes actually setting up a trust for your kids. And I've seen this a lot where, say, a family is coming from significant means, right? And their kid is married and they're like, I freaking hate that chick. Like, that's not going to work out. I told him it's not going to work out. The writing on the wall is that they're going to get divorced in a year, or I know they're staying together for the kids and they're going to get divorced. You can actually set up an irrevocable trust for somebody else to inherit your money so it's not in their name. So then when they get divorced, their spouse doesn't get their inheritance. So that's what I mean. Like there's a lot of these like one-off scenarios, and I'll try to pepper in as many as I can without getting annoying. But there are uses to these. I've seen a lot of people that have used trusts wrong and they have a terrible taste in their mouth because of them. But truly, if utilized properly, trust planning, estate planning, it makes things bulletproof to make sure that what you want to happen happens. Okay. So after your death, right, like trusts can be set up to live on, right? I see that a lot of times where a trust is established where, hey, I don't want my kid inheriting $1 million when they're 20 years old. They're not going to finish school. They're not going to pursue a career. They're going to be an idiot, right? You can really, really, really spell out specifics within a trust as you're going through working with an attorney, to be like, hey, I'm going to leave behind $1 million to my kid. I don't want them to get money until they graduate college, until they get married, until they're buying a house, until they're having their first child. You can be very, very specific, and you can only really do that through trusts. Trusts is going to give you the most control of your legacy beyond the grave. Okay, so there's a lot of charitable options too when it comes to trust planning. I don't want to just sit here all day and give 500 examples, but I could, right? So it's important that you at least explore what the options are. And if you have very specific wishes for your estate, or you have very specific circumstances with the people that need to inherit the money, it's very worth speaking with an attorney, or at a minimum, a financial advisor who might have seen those things before that can tell you, hey, you should talk to an attorney, or I've seen other people do this. So let me just look because I do have questions specifically with the trust stuff. So I kind of want to just look at them quick. Um, Yeah, so I'll go. This is a good question because I think I touched on it and I think it brought it up for them, right? Like so disabilities, right? And I appreciate the question, right? Like I see a lot of people on the big part with disability planning, specifically for like legacy planning, like with children and stuff, is if they're getting some kind of government assistance, right? So like if a child is on Social Security disability because of their disability those benefits are based on their income. Okay, so they can't earn so much, but also too, they can't inherit a certain amount too. So what we'll do is like establish what's called a special needs trust. Okay, and that is what would inherit their inheritance, and then they can slowly pull money from that trust to supplement their lifestyle, and that way it's not going to blow up their benefits. So the same thing is true with asset bases for them, right? A special needs person or a person with a disability, oftentimes if they're receiving benefits, their net worth has to stay under a certain thing. So what you can do is set up like for kids, for example, you can establish what's called like an ABLE account, which I should know what it stands for because I do a lot of work in the special needs place, but I don't off the top of my head. But it's like a separate asset class. So you want to be careful from the sense of disability planning if you are receiving benefits. That's the biggest thing. If you're receiving some kind of government benefit based on your disability, there is additional planning that you should do from an estate planning perspective, whether you're going to be inheriting or whether you're going to be leaving money. Okay. Um, trust. Screen questions. So yeah, so this is a great question too. Like going back to what I was saying about like selecting executors, right? Like, there's horror stories about people siphoning money. There's people, not doing what you would want them to do. They said, like, are there screen out questions that we could like ask potential executors to kind of weed out people that maybe that you wouldn't want doing it, even though you think you can trust them. Unfortunately, I don't have like a list. I bet if you look up online, there might be a little thing, but at the end of the day, just you should have at least, I hope, one or two people in your life that you would be like, they would take a bullet for me, I would take a bullet for them, like I trust them completely and just kind of go with it. Unfortunately, there's bad apples, right? There's bad apples in every industry. There's people do messed up stuff and you kind of can't avoid it, right? But I wish I had a better answer because now I'm scared. All right, so let's get away from trust here. Let's go talk about gifting. One sec. All right, so if just in general, right, you are planning on leaving money to your beneficiaries upon your death, you may want to consider or at least look at what it would be like and if it would be beneficial for your overall strategy to be gifting during your lifetime instead. I think a lot of people overlook this option, but it's a great way to help reduce the taxes of what somebody's going to be paying because you can do it incrementally. And a lot of people like this. I'm seeing this more and more with clients that I have that, they were great savers. They got to retirement. They accumulated more than they'll ever need. And they know that. And they're like, hey, I don't want to just leave my kids with a bunch of money. I want to be able to enjoy life with them. I want to be able to take them all, like my kids and my grandkids, on a cruise every year or, go on a cool trip every year. Like, I want to be able to enjoy this money with them or, feel good that I can help them renovate their home or, pay for weddings, graduations, stuff like that. So gifting really does have a point and a place. It's a great strategy. You just need to be careful with it, right? Because there are rules. Okay. So they can result in certain types of gift taxes. However, like if we play around gift tax exemptions, they're good. So these numbers change all the time. They tick up a little bit every couple years. Like in 2020, here are the numbers, right? Like the annual gift tax exclusion that you can kind of give to somebody almost without any handcuffs associated with it is $15,000 per person per year, right? Up to a maximum of 11.5 million, right? So most people don't hit that number, but it is there, right? I've seen it before. So, that's another way to kind of unwind your estate and not make it a big tax bomb when somebody inherits it. You can be giving all your kids, all your grandkids, all your cousins, whatever, 15 grand a year, kind of free and clear. Okay. A lot of people don't know that or understand it. There are obviously different rules when it comes to charities. There's even marital options, which actually double your 11.5 million. These tools are really, or these rules, I'll say, prevent most gifts from actually getting taxed. You just need to make sure that you're kind of following the rules so the IRS doesn't come knocking on your door. Because let's be real, like you don't want to answer that door if they're there. So, the annual exclusion, it's very, very generous, I think. Just know that you need to play, but beyond like within that rule set, right? 15,000 per person. I think it's closer to 17 right now. I should have had updated numbers, but I totally forgot to do it. So it's just good to know. I think that's one of the biggest things though when it comes to gifting is like twofold, right? It's reducing the tax burden to people that you already know are going to inherit your money, but also too, you're getting the gratification of being able to enjoy that gift or their inheritance with them while you're still alive. Going back to what I was saying, like you can gift them 15 grand and be like, let's redo your kitchen together. I'll help you pick out the paint, right? Some people really, really like that versus just like, hey, when I die, you're going to get a bunch of money, right? So it's a cool way to actually be able to enjoy the inheritance with your loved ones. I think that's where it really comes into play. And obviously to charities, like charitable giving, there's a whole slew of tax benefits. I could do a whole presentation on charitable giving, but that's a part of it too. I think the gifting aspect, it gives people a lot of gratification while they're still alive, but it is an estate planning tool. So let's kind of cover here. I know we're hitting time. I'll start breezing through a little bit more. So, life insurance, obviously, it can serve many different purposes depending on the needs of the insured, how ownership's structured, how beneficiary designations are set up. So for most insureds, life insurance is going to be an important part when it comes to like paying off debts more than paying taxes. Going back to what I was saying, estate taxes are really only an issue if your estate is quite considerable, over $10 million. Most people, estate taxes are not a thing that we need to be planning for, right? But it's a big thing for paying off debts. And like I mentioned earlier, helping reduce tax liability that beneficiaries and heirs are going to be responsible for. Most people and especially in the generation right now that's retiring and or dying, they were very, very, very encouraged to put all their money in a pre-tax 401k when they were saving, right? Because it was like, avoid taxes now, your tax rate's going to be lower in retirement, right? I get that, but now you've swelled up this $1 million pool that's never been taxed. The reality of it is most people don't spend that all down during their lifetime. So they got this big $1 million bucket that when you die, it's going to get plopped on your beneficiary who's probably 40, 50 in their peak earning years in their highest tax bracket. And the government's going to say, no matter what, you got to spend this in the next 10 years, right? And they're going to squeeze all that money out at your beneficiary's higher tax bracket. So that's why the planning ahead of time really comes into play. So with my office, for clients, we do a lot of gifting. We're looking at a lot of Roth conversions. So you can control the taxes while you're still alive, not shoving it to a future generation where they're not going to have as much control. The government's going to put a timetable on them. I don't know about you, but like based on where we are from a national deficit standpoint as a country, I don't see taxes going down in the future. So that's where proactive planning comes into play. Life insurance is a great way to help cover the cost of those taxes, right? There's the strategies that I mentioned earlier, using those pre-tax dollars to fund life insurance contracts. So you're reducing the tax burden and increasing a tax-free death benefit. The Roth conversion strategy is a big one. I think more and more people are familiar with it. It's not something you want to do on your own, right? Like when it comes to Roth conversions, it's really easy to mess up the math, and that math can impact what your Medicare premiums are for quite a long time. So you want to make sure that you're doing it like with a competent attorney, with a competent financial planner that's been doing that for a long time and has experience with it. Okay. So, life insurance, it can represent a very important part of a legacy to heirs. It can provide value. Um, Obviously, whether it's in or out of the estate. So there's a lot to it. If you have questions on that, just let me know. I don't want to spend too much time because I still have other stuff I want to cover, and I've already been talking for an hour. So, like here's a couple strategies, right? And this is just a helpful graphic that's going to kind of show you, how some of this stuff works. Now that we have a better understanding of these different tools, let's kind of look at a couple different strategies that you might want to consider that might make sense for you. Okay. So like, as you can see from the chart here, we've got our different tools, right? Like there's our before death tools, which really it's gifting. I would put Roth conversions in there as well, because I think that's a really good way to clear up the taxes for your next generation. You really need to know what you're doing. Do not do Roth conversions by yourself willy-nilly. Okay. There are games you want to play with that. Okay. And then obviously too, after death, that's where most of these estate planning tools come in, but you need a plan for all this stuff while you're alive. You need to be proactive, do it ahead of time, right? So this ability to avoid probate, it's extremely critical for, as many people as we can, because it's just going to get assets into the hands of your loved ones as quickly as possible. You don't want to die and have everybody that's dealing with your estate, dealing with all this stuff, not getting your funds for 2 years, right? We want this to be timely. We want your estate to flow efficiently, and having this plan in place is going to be the biggest thing. So let's jump through our couple strategies here. For time's sake, I'm going to go a little bit quicker. So sorry about that, but whatever. It is what it is, right? So in this estate planning strategy, like the what's mine is yours strategy, right? All you need is a simple will. Okay. Using this strategy, you'd either kind of bequeath all of your possessions to a single person, right? Which it could be your spouse, it could be your partner, or you're dividing it very fairly among a couple beneficiaries, such as your children, such as your grandchildren. This is the most basic strategy. I think everybody at a minimum should at least look into this. So keep in mind, like I think sometimes too, like once you actually start thinking about these things, you start running into the different roadblocks psychologically. Okay. So I kind of communicate this with people, and like I'm impartial when I'm doing estate planning, right? You need to keep in mind that what's fair is not always equal. And some people struggle with that, but some people know deep down, hey, this kid is fine. They killed it in their career. They married some rich person, whatever, whatever, whatever. Maybe they don't get as much of your inheritance, right? Perhaps, one of the children too that you maybe helped out more during your lifetime, they don't get as much when you pass away, right? There's a lot of different ways to kind of measure this. It's not always like a perfect, like, hey, I've got 4 kids, each one gets 25%. Sometimes it's like, hey, we helped Jimmy pay for college, pay for a house during his lifetime because he was struggling, and now he's not struggling, but we didn't really do much for the other kids during our lifetime. So let me cut them in a little bit more. Like there's different ways that you can do this, and you're not playing favorites. Sometimes you're trying to be fair, right? Another strategy is I'll pick up the tab, right? This one really uses life insurance as kind of a complement. Okay, so In this case, like picking up the tab is anticipated costs. So burial costs, funeral costs, estate settlement costs, legal fees, etc. More like paying off a mortgage, even. You can use life insurance to kind of help in the estate equalization, just so there's no debts, no costs. Life insurance benefits get in the hands of your executor, your beneficiaries, really quick with a named beneficiary. So a lot of people will do that, as an estate plan. They'll have titles on everything, they'll have a will in place, but then they'll have a permanent life insurance policy that they know is going to be there no matter when they die. And when that happens, it's going to pay off the mortgage, pay for their funeral, boom, you're set. Okay. And you can kind of spell that out in a will. You can spell that out in the life insurance policy when you're getting established with it. The goal of this strategy is just to have your beneficiaries receive as much of your estate as possible, by having it, like, any known and expected expenses just covered by that life insurance benefit, which, the beneficiaries that you specified, they're going to get that right away, be able to just start tackling all the debts and clear the estate as quickly as possible, right? Because remember, if you don't have that, and all of the money to pay for this needs to come from your estate itself, that can take some time to get into their hands. Okay. Another strategy, the gift that keeps on giving, right? So this strategy is obviously focused on giving, right? And it's unique in the way that ideally, it's going to play out during your lifetime, not during your death. So of course, you're going to want to have your will as a foundation should you pass away before any of the money that you're planning to distribute's gone, because everyone should have a will. There, I said it again. So there's a lot of reasons why people like implementing the gifting programs in addition to wanting to kind of lower their taxable estates. Remember, like, you can do the monetary gifts every year or on an as needed basis. So it can be planned or it can be unplanned, but the gift that you can change every year can change. And remember, with this plan, you're there to actually enjoy that inheritance with the person year over year. So a lot of people like that. Obviously, if you got $1 million, you're not going to drain down your estate giving each of your three kids 10, 15 grand every year, but you actually get to be there with them to enjoy that money with whatever it is. Like I said, home renovations, vacations, helping them buy a house, all that kind of stuff. A lot more people I'm seeing prefer that nowadays. They want to spend the time with their kids. Another strategy here, the in you I trust strategy, right? So this is kind of based, generally speaking, that you want to kind of give up ownership of your assets, kind of put them in an irrevocable trust, removing them from your estate. So people do this for Medicare planning, or if they have substantial estates. Remember, it's removing it from your name, putting it somewhere else. So in this strategy, at your death, the trustee is going to distribute all your assets according to your wishes. There can be a lot of trusts involved in this, and no trusts, life insurance, not life insurance. Remember, giving up the ownership so bulletproof, no matter what happens to you, no matter how expensive the end of your life costs get, that money's earmarked and set aside, and you can really spell out how you want it spent. I candidly am seeing less and less of that as we move forward and march forward in time. Like 10, 20 years ago, everybody was shoveling money into irrevocable trusts to not lose money to a nursing home, because nursing homes costs were spiking more and more and more. I think long-term care insurance has become more of a thing now, where people feel a little more comfortable, like, hey, I can either self-fund a nursing home for 3, 5 years, or, get some kind of insurance contract in place that'll help buffer those costs. So I'm seeing less and less people completely give up control of their assets, but there are still definite advantages to doing it, right? No matter what happens to you, no matter how expensive it gets, your beneficiaries will get that money. Okay. We're almost done, I promise. So depending on your circumstances here, it may make sense to kind of do a little all of the above. right? Which is a combination of the tools, a combination of the strategies that we discussed, wills, gifts, life insurance, trusts. To give you just one example of how these tools work together, like I was saying before, you can use the death benefits of a life insurance policy to become a funding mechanism to pay the taxes from an inheritance. Like there's a lot to be said there. Candidly, too, this is what I see the most of. It's not a one size fits all financial plan, estate plan. It's typically people implementing all of these different components in a way that they feel comfortable with. Having some kind of a life insurance to pay some kind of taxes or some kind of debts, but also to utilizing gifting for their kids or charities or churches, like whatever it is. It's usually combinations. It's not a straightforward one size fits all plan, right? But also too, there is another plan, right? It's roll the dice. It's do absolutely nothing, taking absolutely nothing from this call and not establishing an estate plan. And guess what? This is the most common one. Okay. I hate saying that, but it's statistically very true. It means you have no plans in place, right? Whatever happens, happens, right? This means some of your assets are going to go through probate. Some might go to the wrong beneficiaries. I cannot tell you how many times I have sat down for a beneficiary review with a client or a new person that I'm talking to and notice like, wait, who's this person on this old 401k you had? And they're like, oh, that's my ex-wife. I should probably move them off there. Or, oh, that's my kid that died last year. Like you need to review these things, right? There needs to be a plan. So if you die without a will, if you die with it out some kind of plan, everything is determined by the state. And 99.9% of the time, it's not going to go the way that you wanted it to. Right? Things are going to flow to the wrong people. Things are going to go to people that can't handle that money at that time. Like I hate this strategy. Please, please, please don't be this person. Okay. But some other considerations, right? Just keep in mind this whole topic, it's complex, right? There's many hoops to jump through. There's like a lot of different things to know and not know. Tax laws are always changing, estate laws are always changing, which honestly, that means that your estate should be monitored. Your estate plan should be monitored and review every 5 years, every 10 years as laws change, as your financial position changes, as your family composition changes. Anytime your financial or family situation changes, realistically, you should be re-reviewing your estate plan. And it can be as quick as a 10, 15-minute look over, right? So because your needs and these tax laws are changing, fluctuating, like I highly implore you, once again, to work with a team of professionals. Everybody should have a tax person. Everybody should have a financial planner. Every person should work with a lawyer or talk to a lawyer at least once in this regard, right? Like everybody goes to the dentist. You need these kind of professionals that are constantly keeping an eye on these things so you don't make a mistake that costs your heirs tens, if not hundreds of thousands of dollars. Okay. So, kind of wrapping up here, we covered a lot of ground today, and I appreciate how many people stuck around. I know I went over the hour. I knew I was gonna. We had a couple really good questions. But ultimately, in summary, right? Like remember the significance of this, right? I think you all know this because you all took the time to sign up and spend an hour listening to me yap about it. Estate planning is really the only way that you can assure your wishes are going to be followed beyond your death. And it's through that estate plan that you can execute efficient strategies that are going to work for your loved ones and making sure that they can get and keep as much as what you're leaving behind as possible. Okay. Consider what your goals actually look like, right? Do you want to leave money behind to friends, family, favorite charities? Make sure you're really thinking about those goals because what you'll want is going to determine how you build that estate plan, what tools you need to use, and how you're spelling out the language of those tools with attorneys. Okay. And lastly, everybody should have a will. I knew I had to say it at least one more time. Okay. Start with a will. That's the most basic thing you can do. It's a very easy to get one established, whether online or with a low cost attorney. It is the starting point of all financial planning. It is going to force you to start creating an inventory and thinking about how you want these things to play out. Okay. And what you want these goals to look like. Okay. So that's the show, right? I'm here as a resource for each and every one of you. You know, as I said, I've been doing this for a long time. There's no fee to talk to me. There is no charge, you know, as members of Advocate, as members of Children's Hospital. I am here as a resource to you, right? There's no charge. I am very happy to talk to whoever about whatever. And, you know, if we do set up a one-on-one, it'll be via Zoom, just like this. We can talk very specifically about your circumstances. I have a whole network of CPAs, attorneys in both like the Wisconsin, Milwaukee area, but as well as like the Illinois, Chicagoland area. It's literally all over the country. So I'm here to help. Take advantage of me, take advantage of my team. Otherwise, I get too bored and just need to keep doing these. So I do have a couple questions, but for the most part, like that is the show. Thank you all so much for being here. I'll hang around for a little bit. You know, if people want to throw questions up in the chat box, I'll do my best to answer some of them, but I do have to run out to Chicago for some meetings later this afternoon, so I can't hang around forever. So let me just run through some of my questions. But thank you so much, everybody. Keep an eye out for the invite next week. I'll send a follow-up email as well to everybody on this call or everybody that signed up for the recording with a copy of the recording, with some additional information that can be used as collateral to kind of help you start piecing this stuff together. I'd rather give you too much and you can sift through it and be like, none of this applies to me, than, you know, not send anything over. So thank you. Thank you so much. Enjoy your summer. We'll see you next month. Okay. So questions, right? Can you convert a 401k with active contributions to a Roth, or is it more of a rollover retirement account after you've left a job? That's a great question. It depends on your plan. Okay. So what you would want to do is contact the 401k administrator, and I'm happy to do this with you so you ask the questions properly, right? But you just need to confirm whether or not the plan itself allows for in-plan conversions. Some do, some don't. Most of the people on this call are with Advocate. I'm almost certain that they do not. So it would need to be in an IRA, but sometimes they change that stuff all the time, especially with the merger now with like Atrium coming in and stuff like that. So it's worth calling the 401k administrator like Empower and just having them boop, 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 pull up your plan and be like, oh, is this an allowable feature or not? They'll be able to answer that question directly. Um, where do you need to file a will with your county? That's a good question. I don't know if you necessarily need to like file the will with the county, as long as it's, you know, where your executor knows where to locate it for when you pass away. I think I would just do a Google search. Honestly, it's going to be different everywhere. I don't know if you need to or are even supposed to, but if you have a will, either give it to your executor right now or make them very aware on where to be able to locate it. Okay. Um, and then somebody else said, I have a Roth and a traditional IRA. Is it wise to convert it all or keep some money in each? It depends on your overall situation and what your goals are, right? Like if you can, I'm a huge fan of Roth, right? Like the more money that you can have in a Roth IRA, the better. But also too, from just a general tax planning purpose, like there's nothing wrong with having some money in a pre-tax account, because when you look at retirement planning, retirement income planning, and you want to start turning those assets into paychecks, right? You have a pretty good marginal window of being able to pull at 20, $30,000 of pre-tax money every year without having any or a significant impact on your Social Security or taxes. So, sometimes people will be like, why don't I convert to everything to Roth? Well, you can. There's nothing wrong with that. But at the same time, just know that you're probably paying taxes on that money that you probably won't need to if you have a good balance between pre-tax and Roth. Because like I said, some of those distributions from the pre-tax, if you're calculating it right and you have a good retirement income plan in place, and this is something, I'm happy to look at with you, you can basically have pre-tax money that's never going to get taxed. It just has to be built into a comprehensive income plan where you're balancing those distributions with Social Security, with Roth distributions, and just being able to control what tax bracket that money is spilling into, if that makes sense. All right. Well, I don't have any other questions, and I've been talking for almost an hour and a half. So I'm going to get rolling out to Chicagoland here. Thank you all so much for joining me on this afternoon. Please take advantage of me. Like I said, like I'm very happy to chat. Everybody's going to get this an email, a follow-up call, a link if you want to register for just a quick chat with me. I'm happy to talk. I nerd out about this stuff so much. It's why I'm here. It's why people don't fall to high places. And I think I wouldn't be here and Advocate wouldn't let me do these talks if, I wasn't here to help. So take advantage of it, everybody. Thank you again from the bottom of my heart for taking the time to actually sit down and listen to this. It means that they're going to keep letting me do them. So everybody take care. You have a good summer. You have a good afternoon. You have a good week. We'll see you next month. Okay, bye.